Well, the Fed cut rates again today. There's a lot going on, a lot to talk about. We're also going to talk about the futures market. They're backing away from the probability of more interest rate cuts. The 10-year Fed funds ratio, well, it could be giving us a warning signal right now. And we have bond market correlations, which all of a sudden have completely collapsed. Today, the Federal Reserve met. Jerome Powell said central bank has to be cautious on rate cuts, rocking markets. They said in particular the central bank revised outlook for the rate cuts in 2025, indicating there will be two reductions, two cuts. Now, that's down from the prior forecast of four interest rate cuts in September. You see, inflation, it's been in a holding pattern. That's what the Fed said, but it's also not coming down. So it might not be appropriate to cut rates yet, especially considering that the jobs market, according to the Fed, is more or less stable. In terms of the Fed futures, they're backing away from future interest rate cuts. In red, the probability for the January meeting will be at 425, 450. The blue bars, that would represent a quarter point cut. And we see now we have a 91% chance of no cut in January, 9% chance of a quarter point cut. Now we take a look at the probabilities overall. In January, again, 94% chance, the aggregate that we will be exactly where we are now. Only a 6% chance will be lower. In March, we're still looking at greater than 50% chance of no interest rate cut. That only changes in May. There's a 64% chance we'll be down a quarter point. That's a lot less than what we just spoke about a couple months ago. And then finally in June, there's an 88% chance that we'll have another interest rate cut by then. The 10-year Fed funds ratio, this is cause for concern. Now, the red bar represents the Federal Reserve interest rates. The blue line, that's 10-year U.S. Treasury. And it's a common measure to subtract one from the other, which we're going to show you in just a moment. But on the surface, take a look at what's happening over the past couple months. The Fed first cut rates in September. Well, lower interest rates added a lot of fuel to the stock market. The stock market really liked the prospect, and there really wasn't any concern at the time, at least according to the markets, of a weakening economy. So the market took off. The blue line went up. That's a 10-year U.S. Treasury. That's forecasting long-term economic growth. Well, then we had another interest rate cut more recently. And the stock market like that as well. The stock market said, hey, listen, even lower interest rates, better for us, better for earnings. And we went up higher. But now we can see that may have changed. What we're looking at here are the Fed funds minus the 10-year. Again, you just take the interest rates now at 4.25, subtract from that the 10-year U.S. Treasury yields. Now, typically we see this in negative territory. Typically we see that the 10-year yield is above the Fed funds, giving us a negative number. But during certain periods of time in history, we see Fed funds are higher. Now think about this. Fed funds are higher than the 10-year yield. It shows us that interest rates are higher than where the economy really is projected to go. That's by the bond market. So for example, in 2007, prior to the financial recession, we saw the Fed funds interest rates were very high. The market was very hot. The Federal Reserve increased interest rates to slow the economy down. Well, the 10-year yield slowed down first, and that caused this. It's not an inversion. It's actually the Fed funds is greater than 10-year yields. This happened again in 2019 before the pandemic. The market was very hot. The Federal Reserve actually started to cut rates, but the 10-year yield had already started to decline. Well, this is where we've been for quite a while now, that the Fed funds, because the Federal Reserve raised interest rates to such an extent, remained higher. Actually, today, as a result of this interest rate cut, we now see the Fed funds is below the 10-year yield. The 10-year yield is at 450 and Fed funds at a 425. So with that said, take a look to see how the market acted the last time we went back into the negative territory, 2008, 2019. It's not to say that history is necessarily going to repeat itself, but it's a little bit of a cause of concern considering the pattern. Now, treasuries are on the move as well. This is our current yield curve. And notice from the 1 year maturity on up, we see ever rising yields. This shows us that the long term prospects are more optimistic than the current prospects. The longer we move out, the longer we look out to the maturity curve, meaning 10-year, 20-year, 30-year maturities, that tells us more into the future, whether we're optimistic or pessimistic. Remember the inverted bond market, which we actually still have in the sense that the 1 year, 1 month is higher than the 1 year. Well, this was also the case in terms of the 1 year being higher than the 5 year, for example. But that's not the case anymore. At least according to the markets, we don't have a very good chance of recession, but rather a good chance of a lot of growth or inflation. You decide. Now, here are the different maturities. This goes back about 2 months. In particular, you can see what has really been the big source of growth in terms of yield over the past couple weeks, especially the yellow line, 10-year maturity, 30-year, that's in blue. Now, here in blue, that's the 10-year bonds. In yellow, this time, the S&P 500. And notice what has happened, especially today. Dow's down, 1,100 something points. The stock market went down as the 10-year yield went up. And this is a very important message that the market sent us. The prices, they don't only reflect how much things cost, like stocks, but also the prices, there's a message within the prices. The message here is very simple. The Federal Reserve is concerned about inflation. They want to take it easy on lowering interest rates anymore, not to risk restoking inflation. Now, the stock market has been on a tear. Well, some parts of the stock market, Tesla, Nvidia, well, that was a couple months ago. But Amazon, these big Magnificent Seven tech stocks, not so much for the Dow 30, by the way, but those stocks that have been performing very well, they've been performing under the guise of low interest rates and lower interest rates in the future. Well, the Federal Reserve says we can't lower interest rates. We're running into the risk of more inflation. The stock market today said, we don't like that. We want lower rates. And the Fed said, we just can't give it to you. The inverted Treasury market correlation, not to be confused with the inverted bond market, that's something different. This is really kind of interesting. In yellow, the S&P 500. In blue, that's the 10-year U.S. Treasury. Now, notice what happened. This is May, June, July of this past year. The yellow line, stocks, that went up. The 10-year U.S. Treasury went down. What was the message here? And these are going in opposite directions. The message here is that, remember, the stock market was anticipating the first interest rate cut. That actually didn't occur until September. But if you recall, May, June, July, we were looking forward to it. The Fed funds futures were getting ready for this. And as a result, stocks found themselves in a very good mood. Well, the 10-year U.S. Treasury was anticipating lower interest rates. It started to go down. So we had an inverted bond market. You see, sometimes, and this is completely normal and understandable, sometimes these lines move in the same direction. It kind of depends on the context of what we're looking at. In yellow again here, that's S&P 500. The white histogram bars show us the correlation, and this is calculated over 20 days. The correlation, how closely the S&P 500 and the 10-year U.S. Treasury yield move. And again, same period of time, May through July, we saw a negative correlation. Stocks up, yields down. Where are we now? Well, now, fast forward to present date, the stock market is really not in a good mood and yields are going up. So we have another inverted bond market, or I'm sorry, not inverted bond market, an inverted correlation, a negative correlation. Stocks down, yields up. It's a different story. It's just you take the old story from May, June, July, turn it on its head. In May, June, July, we saw the prospect of lower interest rates and stocks really like that. Now we see the prospect, maybe not so much lower rates anytime soon, a lot less than we thought before at any rate. And the stock market doesn't like that. That's what we see right now. Stocks down, especially today, and yields on the 10-year skyrocketing. And we can see exactly that relationship between the two. Very interesting how we turn everything on its head from the May, June, July period. So, what's the message behind the prices? Number one, the Fed is in a holding pattern. They're not satisfied with the current levels of inflation. They say they're in a holding pattern, that inflation is kind of stuck, but it's not going down. We spoke about PPI, CPI, and soon we have PCE. We'll probably see more of the same. Number two, the bond market is forecasting future growth and inflation in the sense that the 10-year yields are quite strong. And number three, the 10-year Treasury is also too close for comfort. Yields are too strong for future Fed cuts. You think about it, we're cutting rates, or the Fed's cutting rates in part because they expect a weakening economy and a very low threat of inflation. That's why the Fed should cut rates, to save the jobs market, not let that fall apart, and not when there's any kind of, because there's a lack of fear for inflation. But now we see the 10-year Treasury is very strong. That's signaling a threat of inflation. And it's telling us there's really no risk of a weak job market. That's why the Fed has pulled from 4 future cuts back to 2. And that's why the stock market took it so seriously. Stock market looks at these economic numbers. In some sense, it actually kind of agrees with the Fed. As a reminder, we're also launching, or in the process of launching, our Economics 101 series, where we talk about a number of the different major economic numbers, such as retail sales, we spoke about recently. That's actually a very interesting report. We try to really tie that in with the overall economy and, add the significance of these numbers. We hope this has been helpful. We look forward to seeing you back soon.